Hey everybody, we're going to give it a minute or so, let people join. You can take in this lovely slide while we're waiting. I don't know. It feels like a magic number to you, Daniel.
Yeah, I think we can start
I
rolling.
think, yeah, I feel good. Good to see it. Well, I don't see any of you, but good to meet all of you, kind of. My name's Carl Mill. I'm with Daniel Felix. We're going to be doing this talk on the welfare exemption and overview for affordable housing projects. Just as a quick, I'll intro myself real quick, and Daniel can intro himself. I'm an attorney at Mill Law Center. We're a 5-attorney law firm in San Francisco, LA, Atlanta, Boston, Maryland, spread out, all doing nonprofit work. So corporate tax, other compliance work for nonprofit, all the stuff that goes into a nonprofit by virtue of being a nonprofit or exempt organization. That includes, housing projects and certainly property exemption to some degree. But Daniel here's the expert on that. I'll let him introduce himself.
Yeah, thanks, Carl. So, hi everyone. My name is Daniel Felix. I'm an attorney with Downs, Pham and Quay out in San Francisco. And our firm specializes primarily in real estate with an affordable housing component and primarily represent developers, both nonprofit and for-profit, relating to the acquisition, sale of affordable housing projects. The practice is generally national in scope, just given that the projects we primarily work with are based on the federal tax code for low-income housing tax credits. Like I said, we're based out of San Francisco, but we do have folks out in Southern California, including myself, out in Los Angeles.
Yeah, that's awesome. I'm gonna get us started, and like Daniel and I both are federal tax lawyers to some degree, and California lawyers to some degree, and other kinds of lawyers when we need to be. So, this will be hopefully as fun as a presentation by two lawyers can be. I'm going to give you kind of a start here with what we're going to be talking about. I guess even before that, being lawyers, let's start with disclaimers. Disclaimer number one, obviously this is general educational information. You might sometimes think it sounds like we're giving that something that sounds a lot like legal advice to you. I can assure you that we are not. Obviously, just general education. Always happy to chat after this, but this is doesn't create any attorney-client relationship, et cetera, et cetera. Disclaimer. The other thing I want to make sure you understand, we're going to take questions on this as we go. You see that there's a spot at the end of the outline for Q&A, but we're also really interested in your questions as we go. We're even more interested in them if you put them in the Q&A section of the chat and not the regular chat section. They'll be easier to find. Daniel's going to try to keep an eye on the questions while I talk. I'll keep an eye on the questions while he talks, and we'll try to cover the interesting ones. If we haven't addressed your question, it either means we'll save it for the end, or it might just not be the right time. But we'll try to cover all the good questions we can. Let me kind of walk you through this outline. So like I mentioned, I'm a nonprofit lawyer specialized in representing nonprofits. We do a lot of work with the welfare exemption. I would say 95% of the time I'm dealing with the welfare exemption. I'm dealing with the more general one than the housing specific one. So I want to use that as an opportunity to talk through how the welfare exemption works, what the requirements are, some sort of key principles that come up in sort of basic filing procedures. You might sort of wonder, well, do we really need that? We really just want to talk about the details of housing stuff. I would say, well, look, I think a lot of those questions, you'll find that a lot of the questions you might have that are affordable housing specific, actually, you can find a lot of the answers in these general principles. And frankly, even if that's not true, it's too late. This is what the presentation is. Once I wrap up my part of the presentation, I'm gonna hand off to Daniel. Daniel is the affordable housing expert, and he can sort of do more of a deep dive into 214G, which is the welfare exemption specific to low-income housing projects. And that's where we'll get into a bit more of the details. And like I said, we're gonna leave room for questions. So if we're not addressing your desired topic specifically, feel free to ask, and we'll do what we can, subject to all the other disclaimers. So with that in mind, I'm going to get us started by talking about the welfare exemption, how it works, the key legal concepts. But first, over philosophizing, I kind of created this chart just as a reminder of how we can think about the property tax system and how California's property taxes work. You see, I put on the right a thing about Prop 13. That's just sort of a general thing. We all know that one of the things that reduces the property tax base here in California is Prop 13. It does so in a different way. It does so by sort of setting, locking in the values of property taxes, of the property tax base based on change of ownership, stuff you all know and we're not going to talk about at all. So please don't talk to us about Prop 13 today. The thing we are going to talk about is the other thing that eats into California's property tax base, which are exemptions. So exemptions are things that pull real property that would otherwise be subject to the property tax out of the property tax base, so they're not subject to tax. Sometimes that's a complete exemption, and sometimes, as we'll talk about during the affordable housing section of this in particular, it's a partial exemption. Either way, these are things that pull property out. You'll see, you could picture a whole bunch of tiny little white holes there. There's all kinds of things throughout the code that carve out property from property tax. I will tell you the ones I deal with the most often are the welfare exemption, the religious exemption, and church exemption, but honestly, mostly the welfare exemption. And as we'll talk about on the next slide, the welfare exemption contains multitudes. There's also many other exemptions, cemetery exemptions, other random exemptions that were lobbied into the statute. But for today, we're just going to focus on the welfare exemption, and let's start by kind of breaking that into what it means. You can find the welfare exemption in section 214 of the Revenue and Tax Code section, California Revenue and Tax Code section, obviously. You'll see I kind of bifurcated into the two code sections we are the most interested in. I would call 214A the standard welfare exemption. It is the exemption that most nonprofits, when conducting charitable activity with their property, will look to establish exemption under. In a way, you could think of it as including the other exemptions because some of the requirements in 214A apply to other types. That's why we're going to spend time talking about 214A, because it's relevant to all exemption projects. It's also important to consider because obviously some of you are sort of nonprofit for-profit partnerships. In those situations where you have a project that is 100% owned by a nonprofit, maybe you're doing housing, maybe you're doing stuff in addition to housing, the regular welfare exemption can matter quite a bit. And we'll talk about what the requirements are there, how they differ from the low-income housing exemption. In some ways, it's more restrictive. In some ways, it's less restrictive than 214G. And we'll talk about it as we go. And like I said, Daniel will cover 214G. You can see all the other great code subsections that we're leaving out. The elderly housing exemption, the employee housing exemption, college exemption, educational radio. We're not talking about any of that stuff. You can think of all of these as sort of spin-offs of the welfare exemption. Maybe something where there's a sort of standard welfare exemption principles that may or may not allow these things to be exempt, but because we favor these things in some way or another, we're going to make a little extra space for them. So just to get into details here, I want to start with the key requirements of the welfare exemption. Again, maybe this is all stuff you already knew, but I think it's good to recap, and maybe it's something you haven't thought about in a while and could come up in a surprising way on one of your projects. So for property to qualify for exemption, it's got to satisfy all of these requirements for the welfare exemption. It's got to be exclusively owned by a 501c3 entity. I am using 501c3 entity as a bit of a shorthand. 501c3 is a federal tax term, and the California term would be 23701D. You could also call it charitable, educational, religious, but it's that kind of entity, the kind of entity that establishes exemption under 501c3. Can also include an LLC that is entirely owned by 501c3 entities as long as it follows the proper procedures. But this is a fundamental part of the welfare exemption that we can't lose sight of. In general, the standard welfare exemption, unlike the low-income housing exception, requires 100% nonprofit ownership, 501c3 ownership to be specific. We'll talk about how 214G is a little bit different. It needs to be exclusively operated by 501c3 entities. So your charity owns a piece of property, it's going to do, let's say, a school or whatever. Rather than operate that school itself, it hires third-party contractor Carl to come in and run the entire school for you. Perhaps it leases it to you to run the school. That is not, you've lost exemption to that property because it's no longer exclusively operated by 501c3 entities. It's partially operated by Carl, and Carl is not a 501c3 entity. So another key part of the welfare exemption, it needs to be owned by 501c3s. It needs to be operated by 501c3s. And it also needs to be exclusively operated for a 214 purpose. 214 as in Revenue Tax Code 214, which is basically the same thing as 501c3, but there's a little bit of additional detail on education that I won't bore you with because this is a housing talk. But what that is, all that adds up to is, think about it this way. Let's say charity is the owner of the property. Charity is the only one that uses the property. That's great. It's also not enough. The use itself needs to be exclusively charitable. So, and we'll get into more details about what exclusively means in that context. But it's not, it's about who owns it, it's about who operates it, and it's about what it's used for. All three of those things are critical. This is a fun exception that people don't think about enough. Property in use does not exceed an amount reasonably necessary to accomplishing the exempt purpose. So let's say you have 300 acres of land. On an acre right in the middle, you have a little cabin. And in that cabin, you have a great yoga retreat. I wish this was a fake example. Would you like, if let's say this person in this little cabin says, okay, well, I'm going to give this to my charity. I'm going to give the 300 acres to my charity. It's going to run the yoga retreat. This tiny little cabin in the middle of 300 acres is exclusively operated for a yoga retreat, which we'll call an exempt purpose for today. Do you get to make the entire property exempt? Well, the answer is no, because I would say that is not reasonably necessary to the yoga retreat. You would counter and say, well, when we do yoga at the cabin afterwards, we like to take long 300-acre walks. I would say, sorry, that is still not reasonably necessary and does not take the entire property out of exempt status. But this is something, and you'll hear us say this a bunch of times, what reasonably necessary means is going to be in the discretion of the county assessor. So this is something that we've certainly argued about with county assessors over the years, about whether the property we're claiming exemption for is really reasonably necessary to conduct the exempt purpose, or are we trying to take entire 300 acres out of exemption with a tiny little bit of usage. Exclusive means exclusive. I have a whole slide on this I'll talk about later, but this is an important concept I want to come back to. There's general 501c3 requirements associated with the use of property. No private inurement, the assets need to be irrevocably dedicated. I kind of have this as a little bit too different for 214G, only in the sense of, well, when it'll make sense when we get there, but you all know when you're dealing with affordable housing projects, you don't have exclusive ownership, which means your for-profit owners of the partnership aren't going to have these irrevocable dedication clauses. So it's something that's important, but kind of a little bit different for those projects. And last, you have this general prohibition, which applies to all welfare exemption housing and non-housing. No operation of property to benefit any officer, trustee, director. You can read for yourselves. But the gist is, I would call that, in using 501c3 language, the no excessive private benefit provision. This needs to be operated for the purpose that the exemption is established for. It can't secretly be operated for a private purpose of enriching particular people, at least outside the bounds of whatever arrangement you have. So there's also no use for fraternal or lodge purposes, but I don't think we need to talk about that today. When is exclusive exclusive? If you're asking this question in a romantic relationship, it's a very different situation, but I encourage you to be asking this question in the context of your property tax exemption, because exclusive really does mean exclusive and is often a frequently litigated matter with the county assessor and the BOE. In 501c3 context, most of where I'm practicing in the federal tax exemption, exclusive doesn't really mean exclusive. Exclusive means something more like, well, there's no substantial non-exempt purpose. So exclusive doesn't mean you can never do non-exempt things. It just means don't have a substantial purpose of doing non-exempt things. So, you know, you're a school that runs a car wash 10 times a year, that's fine. If you spend 3 months running a car wash, now you lose your entire exemption. Terrible example, but you get the gist of it. Exclusive doesn't literally mean exclusive. In the welfare exemption context, it comes a lot closer to meaning exclusive. So even one entirely unrelated use of the property that is not incidental to charitable purposes can disqualify the entirety of the property's exemption. And I will say different county assessors have different thresholds, but I'll give you a classic example that comes up. And I'm sure that someone on this call is going to think about a situation with their nonprofit where it could have come up for them. Something that came up a lot was, so I had a client that had sort of an artist's retreat, and their artist's retreat, you know, most of the year was hosting artists. You know, that's great, I guess, for carrying out their charitable purpose. The problem is when the unit property was vacant, they really like to Airbnb it. And it only happened once or twice, maybe 3 times a year. but it made them some extra money they could use on their activities. That is not a related use. And even one Airbnb of that property can eliminate the property tax exemption. So when I say these sort of welfare exemption principles are important, and across all kinds of welfare exemption properties, this is an example of what I mean. This exclusivity is built into the statute. It needs to be satisfied. You need to be careful about not allowing your property to be used for something that's not part of the permitted purpose. Generating revenue is not an exempt purpose. That's always one of my favorite things. So in an example, they might have come back and said, well, it is related because when we get money from the Airbnb, we spend it on a program. Well, by that definition, everything is related that generates money, and that's not how that works. Generating revenue is not an exempt purpose. 214 does allow occasional fundraising. It's not as long as it's not UBI generating. But true, if the only connection, it requires it not be UBI generating. We'll talk about that separately in a second. Incidental uses can be okay. Before I read that last thing, I just kind of want to pause. I mean, we kind of have several magic words: exclusive, incidental, and occasional. And these are all different words that are used in sort of very blurry fashion. Exclusive might quite mean exclusive, but it certainly means nothing that's unrelated. And to the extent that there is anything, it's got to be at least incidental. An example of what incidental means, the BOE gives us annotation 8AB.009, and you can give some examples of what incidental is. These are things that, okay, it's not exactly charitable. Some of the things arguably are, honestly, but legal services, exercise activities, tax prep services, those are things that aren't necessarily charitable activities, and certainly they're not housing activities. But the BOE made the annotation of, okay, in the context of housing, these could be incidental because, in a supportive housing program, you might have these things and offer these things. And yes, they are not housing, but they are still incidental to the activities. They're not unrelated to the activities. I don't know why I keep bringing up car washes, but a car wash for people who don't live at the housing complex, but I would say not be an exempt activity and could be a disqualifying business activity. So these are the exclusivity, I think, in the context of the welfare exemption is what I tend to talk about the most when I'm talking to clients and the issues they tend to bump into. I kind of wanted to bring this up again. What's the difference between disqualifying and incidental? This is where the law gives you the standard where it must be decided on a case-by-case basis based on all the facts of the situation, which is one of those meaningless standards. It says, well, I'll just look at everything and see how you feel about it. And so I kind of thought it might be helpful by listing some of the factors on the left here, based on the handbook, other sort of guidance we've gotten from the BOE about when is something incidental and when is it disqualifying. So I'm going to start on the right column. Things that are disqualifying, things that signal commercial activity that should disqualify the property's use, disqualify the property from exemption. If the activity is being conducted with excessive salaries, if the activity is being done in competition with commercial actors, that's what's important to UBIT, which we'll talk about in a second. Is the activity geared towards being profitable? Is the only relationship to the exempt activity the generation of revenue? These are all things that make an activity disqualifying. Factors that might be helpful in making an activity incidental, and incidental being good because it's sort of, you might think of it as related enough to your exempt activity that it won't disqualify your property. Is the organization soliciting donations to support that activity? That's a sign it's really kind of part of the overall charitable network of activities. Does the activity involve volunteers? Is the activity geared towards being educational as opposed to profitable? Is there a direct relationship to exempt activity? And the classic example there is the snack bar at a theater. Yes, a snack bar is an unrelated business that exists to generate revenue, but it's also something that's there for the convenience of the patrons, and therefore something that in court cases, the courts have generally found is incidental as opposed to unrelated. I think you have this note at the bottom, I just kind of want to make sure we call it out. It's not about whether it's profitable. It's about, schools make plenty of money off their tuition. You may be familiar with Harvard, which has plenty of money and all of its property is still exempt. It's only about the purpose, is what is the thing what is the activity that's generating the income? Not where the income is going, what's generating the income. And that'll help you determine whether it's a disqualifying activity. And I'm going to keep rolling here because I want to get to Daniel's section. I think ultimately the questions that will come up will be better answered by his section. This is, again, sort of the overarching welfare exemption that applies to all nonprofits and the property they own for all kinds of uses. I want to talk about the unrelated business income reduction, the welfare exemption, and again, all welfare exemption. This is an issue where the amount of exemption is reduced by the amount of unrelated business income generated. Unrelated business income is a talk that we could do separately for a couple hours, and I have done separately for a couple hours and would prefer not to today. I'll boil it down to unrelated business income is income from an activity that is regularly carried on for the production of income and is not substantially related to the accomplishment of exempt purposes. So like I said, we could talk about this a long time. One way to, I mean, fundamentally, your organization has, if the organization reports unrelated business income, you have a property tax exemption issue. If that property is generating the unrelated business income, you should expect a reduction of your exemption. Substantially related to exempt purposes would require a discussion of everything that's charitable and everything that's not. We're not going to go there. I do want to cover briefly regularly carried on. Regularly carried on means carried on to the same extent as a regular commercial actor. So if this activity you're doing, this fundraising activity you're doing, this business activity you're doing takes place once or twice a year, every so often, but not regularly, that's generally not going to generate unrelated business income. That'll meet an exception, and therefore you don't have a property tax exemption issue on this basis anyway. However, but it's all based on sort of how a normal business would operate it. So let's say you own part of your property in the back, you have an ice rink and you charge money for people to skate on the ice rink. And you said, no, we don't regularly carry this on. We just do it during the winter. Well, that's not helpful, because regularly carried on in the context of an ice rink would be during the winter. So that would be something that would be regularly carried on. So these are UBI principles. Like I said, a larger talk. Just understand that if you have unrelated business income, your accountants are going to tell, there's going to be a question on one of the forms we talk about that'll result in your exemption being reduced in proportion to the amount of income, potentially in relation to the amount of time allocated to that activity. Procedural stuff that I think you all know of pretty well, so I'm just going to kind of skip through it relatively quickly, but it connects back to the requirements we've talked about. We know that one step is to establish the organizational clearance certificate for the nonprofit owner. That's BOE 277. You'll see I highlighted some of the questions below, which is sort of which of these purposes does your organization fall into? And you'll see there's a special box for low-income housing, which will be certainly relevant to Daniel's talk. All pretty straightforward there. That's an important part of establishing welfare exemption. The next step is to apply to the county assessor that your specific use is charitable. Remember, you can kind of think back the requirements. It's about being owned by a nonprofit, operated by a nonprofit, and for a nonprofit purpose. Well, owned and operated by a nonprofit, we can kind of get through the OCC. BOE 267, where we're applying for a welfare exemption, is about, is the actual use charitable? So this is the opportunity to explain what you're doing and why it's charitable. And you'll see I took two snippets just to show, connect it to what we just talked about. Obviously, there's the connection of low-income housing, and that'll trigger additional forms to file that Daniel will talk about. And there's the unrelated business income rule. If you check the box, yes, if this property is generating unrelated business income, prepare to answer some questions that will result in your exemption being reduced. BOE 26670, these are nonprofit properties with other nonprofit operators. I think that's pretty self-explanatory. I do just want to remind you guys of the general principle that both for 214A and even for 214G, as we'll talk about, 214G expands the universe of people who can own and operate a property, but only slightly, only to this certain kind of limited partnership that Daniel's going to talk about. Generally speaking, you need a qualified owner and operator at all times. If you lease out your property to a for-profit, even if they're doing charitable stuff on it, you're going to lose the property tax exemption. I'll use this to transition to 214G just to get things kicked up for Daniel. I want to remind everyone the key requirements, and I'm going to highlight the ones that are about to get twisted. Effectively owned by 501c3 entities, as Daniel will talk about, low-income housing projects can be owned and typically are owned by partnerships that are a mix of nonprofit and for-profit ownership. They need to be exclusively operated by 501c3 entities, but again, under 214G, that universe is expanded slightly. Exclusively operated for a 214 purpose. This is a little bit different insofar as in the affordable housing world, you're typically talking about a partial exemption, at least if you don't have 100% affordable units. The other principles basically stay the same. And I think with that, I'm going to pause to see if there's any questions I should take before we go. Paul asks, is property owned by a public agency always categorically exempt without the need to obtain a welfare exemption? My recollection is that public agencies are typically exempt under a different provision. But in general, it is true that public agencies get all the sort of the same benefits as nonprofits get. They're treated at least as well as nonprofits, if not better. So I do believe that public land is subject to a different exemption. And Daniel, you can correct me if I'm wrong. And the question is, does BOE or the local assessor assure a nonprofit is truly operating the property? At least in the past, sort of shell nonprofits partnered with developers to establish exemption. The for-profit was obviously making decisions, but no one seemed to be policing it. This is sort of like the big picture question, right? The short answer is the assessor is going to be charged with day-to-day administration. Ultimately, appeals go up to the BOE. Our people, there and when you get into sort of how these things are structured, it becomes important for the nonprofit to be the GP of the partnership, and Daniel will talk about that. But your question relates to all sorts of things I come up with, where yes, the nonprofit is the owner and operator in name, and we have situations where that is sort of effectively being contracted out or delegated. And where is the line between the nonprofit maintaining stewardship of the property and the nonprofit having outsourced it and hiring contractors that help it do it? What I'll say from my perspective is it certainly comes up from time to time where assessors will flag these issues. I've had it flagged with sort of private schools and programs they've had sort of bring in outside consultants. When it really becomes important from a legal perspective and from your organization's perspective, review the contracts closely when you draft those contracts with people who are going to look a lot like operators of your program to make sure they're not operating your property. They are supporting you as you operate your property. And I think, Daniel, correct me if I'm wrong, but I think that's kind of fundamental to the GP relationship with other for-profits, is that the GP is going to be the operator. And with that, I'll hand it off to you, but please keep dropping questions in the chat and we'll come back at the end.
Yeah, well, thank you. First of all, thank you, Scamp, for having us here and being able to present on this topic here. Thank you to Carl for an amazing introduction here on the welfare tax exemption. And like Carl said, we're attorneys here, so just another disclaimer or repetition of that disclaimer that I'm not providing any specific legal advice to anyone here. Is more of a general discussion and presentation of the welfare tax exemption for affordable housing properties. Also, Carl, I think it might make sense. I'll try to cruise through my slides here and get to Williams and Corin's questions. I think that makes the most sense. Some of those questions might be answered in the presentation, but if not, we're certainly open to setting aside some time and answering them. And in the event that we don't have time, you can certainly feel free to shoot us an email. We can discuss offline. Okay, so as Carl had mentioned here, I'm going to be focusing here primarily on the welfare tax exemption related to affordable housing projects, which is found in Revenue and Taxation Code section 214G. And just a bit of historical background on this. Initially, property tax administrators took a very narrow approach and interpretation of the welfare tax exemption, and initially viewed this housing as a private use and not an exempt purpose. That later went up to the courts, and the courts decided to take a much more broad interpretation of the welfare tax exemption and determined, well, if the housing is really owned and operated by a nonprofit corporation and it is exclusively serving an exempt use, then we should deem residential housing as an exempt use. So with that, we turned to 214G, and we kind of see that expanded interpretation in the code. And essentially, the exemption is in some instances a partial exemption equal to the percentage of units at the property that are serving lower income tenants and also rent restricted. But it is important to note that the board property tax rules make it clear that your actual exemption is based on the use of your property. So in practice, what that looks like is if you say, you have a bond regulatory agreement which restricts 20% of your units to tenants at 50% of area median income, but your actual use is 80% or 100% of the tenants qualify under the tax exemption, you will receive your tax exemption based on the 80% usage or 100% usage of the property. So it's not limited to the actual percentage in your encumbrance on title. Okay, so also what's critical here to understanding Section 214G is what organizations qualify. And as Carl mentioned in his prior slides, it's a bit of a deviation from the remainder of 214 in that you have a what I would call a third type of ownership structure that qualifies for the welfare exemption, which is the limited partnership ownership structure that has a managing general partner and the general partner position. And the reason for that is that the primary vehicle, for the most part, in affordable housing transactions here in California is the use of a limited partnership, which requires you have two partners. You have a general partner and a limited partner. And based on that, the industry was able to get the limited partnership structure as a qualifying organization under Section 214. And above that, obviously, as Carl had mentioned, nonprofit corporations qualify, religious, hospital, scientific, charitable funds, foundations, and corporations also qualify. But given the nature of the industry and the focus here on affordable housing, we'll be looking primarily to limited partnerships. As I had mentioned, because limited partnerships qualify as an organization, you have to look at what qualifies as a managing general partner. And here under Section 214G, a managing general partner of the partnership can either be a nonprofit corporation exempt under 501c3 or California Revenue and Taxation Code 23701D, or it could also be a limited liability company with its owners called members in a limited liability company, being nonprofit corporations. There are instances in which the limited liability companies are owned by multiple members, but each member must be a nonprofit corporation meeting all the qualifications under 214G and all the board property tax rules. So essentially that means each member must have an unrevoked determination letter from the IRS or the California Franchise Tax Board. Carl went over the 501c3 aspect of the ownership structure. When we're looking at limited partnerships in which the managing general partner is in LLC, there are additional requirements by board property tax rule 136. And for the most part, this mirrors exempt purposes that you would see for a nonprofit corporation. So if an entity intends on forming a limited liability company to serve as a managing general partner, its articles of organization filed with the California Secretary of State must be added, typically as an addendum to the articles of organization. And a few of those requirements are listed here. I'll run through these quickly. The articles of organization must state, have a statement which limits the activities to one or more exempt purposes, just like a nonprofit corporation. The company must state that's operated exclusively to further those exempt purposes. As I stated earlier, each member of the company must be a qualifying organization. So essentially a nonprofit, you can't have a nonprofit in the ownership structure. There must be a prohibition on direct or indirect transfer of membership interest to a non-qualified person or entity. Again, this is getting to the core of the welfare tax exemption, that it must not be for profit use. You must have a dedication clause you also must have a dissolution clause, very much like a nonprofit corporation. You must have a statement that any amendments to your articles of organization are consistent with 214G, so as to not disqualify the LLC under the exemption rules. You will also be required to have a prohibition on the merging or converting into a for-profit entity. And lastly, you must have a prohibition on the distribution of assets to members who cease to qualify under 214G, essentially meaning a for-profit corporation. I thought it'd be useful, when we talk about these concepts, some of it is legal mumbo jumbo and may, fly over people's heads in certain conversations. So I always think it's useful to kind of have a flow chart or a graph showing what that actual entity ownership looks like. So on the left is what Carl had been alluding to in his presentation, which is obviously a managing general partner can be a qualifying nonprofit corporation. So on the left-hand side, you see that just a 501c3, obviously governed by its board or executive committee. On the right-hand side, I'm sorry, you'll see the limited liability company structure in which the LLC is wholly owned by a nonprofit corporation. As I mentioned earlier, you could also have multiple members so long as each member is a qualifying nonprofit corporation. Okay, so when we think about the managing general partner as a general partner in a limited partnership structure, I wanted to kind of show everyone here what that might look like. So this in this fact scenario here, I'm showing the group a joint venture in which there is a for-profit entity involved in the ownership structure. So that for-profit entity is typically an administrative general partner. As I mentioned earlier, you have your managing general partner, which may be a nonprofit corporation or LLC wholly owned by a nonprofit corporation. And then in limited partner, commonly in tax credit deals, your limited partner is your tax credit investor, but it could be any other entity as well. If we go to the next slide, Carl.
Can I just ask a quick question?
Yeah, sure.
Going back to, I think kind of connects to the question William asked before. What's the relationship between the administrative general partner and the managing general partners? Does the administration general partner ultimately sort of report to the manager in terms of who has authority to make decisions, and what's sort of the difference between those two things?
Yeah, sure. Yeah, if you move to the next slide, I'll discuss that. So, yeah, and there's variations of the limited partnership structure, but generally, if you can have multiple partners in a partnership. So when you have this very identical structure with an administrative general partner and a managing general partner, the relationship is very much the same. So you have the administrative general partner managing the project together with the nonprofit partner. We'll get to it in a minute here, but the distinction is that the managing general partner is statutorily required for purposes of obtaining the tax exemption to do very specific things related to the tax exemption, which we'll get to in a second here. But generally, when you see a structure with an administrative general partner, you're talking about a for-profit entity, and the managing general partner is in the partnership to manage the partnership and also help qualify the project for tax exemption. But that also presents an issue where, this is not the only structure that you can have qualify for tax exemption. We could also show here the removal of the administrative general partner, where the partnership would be composed solely of the nonprofit managing general partner and a limited partner. And there certainly are nonprofit corporations that do control the partnership. So you wouldn't have the only for-profit entity you might have is your tax credit partner. Okay, so if we look here, now that we've discussed what the ownership structure looks like and what qualifies, if we look closely to low-income properties that qualify, there are a few requirements, and there's additional properties that qualify, but the ones that we'll focus on primarily are the following: that the acquisition, construction, development must be what is called governmentally financed. So that essentially means bond finance, local, state, or federal loans or grants, with restrictions on the property that restrict both the actual usage of the property to lower income tenants and rent restrictions. And the other option you have here is that the owner is eligible for and receives low-income housing tax credits. And I'll just note here, in projects that are eligible and receive low-income housing tax credit, at your application for your supplemental clearance certificate, you are able to provide a tax credit reservation letter with your application, which proves to the county assessor that the project will receive tax credits. And that tax credit reservation letter is essentially TCAC showing to the owner that it will receive tax credits. This is a pretty common question we get from clients, and it's an important question given the nature of 214G, which has a requirement of government financing. There are instances, for example, in a third-party acquisition where there is a purchase and sale of a property. There are many instances in which we'll use an example of a bond regulatory agreement, which has a 55-year term, that the actual financing has been paid off. So in those instances, the board property tax rules make clear that the way that these rules are interpreted is that the property is deemed to have had the government financing or tax credits for the term of the regulatory agreement, even though the bonds have been redeemed and paid off or the tax credits have burned off. So just as a quick example here, you may have a 55-year bond regulatory agreement in which the bond financing, let's say, was paid off in year 10 of your ownership. So what that essentially means is that you have another 45 years remaining of qualifying for the exemption, assuming all the requirements are met, based on the fact that you have a 55-year regulatory agreement on the property. Okay, and Carl, this kind of goes to your point earlier in your question about what's the relationship here to the for-profit administrative general partner, assuming they're in the ownership structure and the managing general partner. So these tax exemption rules related to affordable housing actually do require and that the owner demonstrate that the nonprofit is actually in a managing position of the partnership. And that's primarily found in Board Property Tax Rule 140.1, which essentially requires your limited partnership agreements. So this is your agreement between the general partners and the limited partner. It will require that the managing general partner, which is a nonprofit or the LLC wholly owned by the nonprofit, that it's designated in the partnership as a managing general partner. It sounds like a silly requirement, but it is a check the box type of requirement on your supplemental clearance certificate. So the way that you satisfy this requirement is you simply say that, nonprofit general partner is the managing general partner of the partnership. The LPA must also provide that the managing general partner receives a partnership management fee, and that management fee is typically a fee for the services that the managing general partner is providing to the partnership. That's a negotiable fee on every deal. Sometimes that fee is payable as an operating expense, meaning it comes before payment of your cash flow provision, so your loan and other debt. And other times that partnership management fee comes out of your cash flow, meaning it's staggered, and that management fee is below payment of your debt or other fees to other partners. What's key here to this board property tax rule is that the managing general partner must have what is called material participation that shows that the nonprofit has control and management of a limited partnership. And there's a few key points to address here, what they mean by material participation. Essentially, that means that the managing general partner has a right to vote in all major decisions. And that essentially means that it has a right to vote in all acts that require a majority of interest in the general partners. The managing general partner must perform what are called 5 of the substantial management duties. It must be explicit in your partnership agreement that the managing general partner will either directly or indirectly under supervision manage limited partnership. There is also a requirement for material participation that the managing general partners annually conduct a physical inspection of the property to ensure compliance with 214G. And lastly, the managing general partner should be required to submit a certification to the county assessor showing that the property meets all the requirements of the welfare tax exemption. Some of the last 2 requirements here that we'll move through quickly is that the managing general partner must maintain records and documents evidencing that its duties are performed to show the county assessor and the BOE that the nonprofit is actually a participant in the ownership structure. And also, it's not uncommon and it's allowed that the managing general partner may delegate some of its management duties to other entities, so long as it can demonstrate that it's actually supervising those duties. So procedurally, we'll run through this pretty quickly so we can take some questions here. The claims for the property tax exemption should be filed with the assessor of the county where the property is located, generally on or before February 15th. The lien date is January 1st. But the assessor may not approve the property tax exemption until the nonprofit partner receives an organizational clearance certificate, which Carl alluded to earlier. And the board will actually issue an organizational clearance certificate for both the nonprofit and the limited liability company in instances where the LLC is acting as a managing general partner. And that's important because both the nonprofit and assuming you have an LLC will need an organizational clearance certificate in order to submit what is called a supplemental clearance certificate for the limited partnership, which I'll talk about here in a second. I think it's important to note here, despite all the rules that we're talking about, and assuming you check all the boxes and meet the requirements of the tax exemption rules, ultimate discretion is with the county assessor whether to determine whether the claimant is meeting the requirements of the tax exemption rules. And essentially what that means is that they can have the ability to audit or verify the operations of the property to ensure that it's meeting the requirements of the tax exemption rules, or flat out deny the request. As I stated a second ago, assuming that your nonprofit has an organizational clearance certificate and your LLC has one as well, assuming that's applicable, the managing general partner will have to apply for what is called a supplemental clearance certificate for the low-income housing property, which is specific to the property and the limited partnership. And Carl, if we move to the next slide, I'll kind of talk about quickly what's required in there. So very similar to your organizational clearance certificate for your nonprofit corporation and your limited liability company, there's a few documents that you'll need to provide to the assessor on the prescribed forms showing that it meets the requirements. Some of those requirements are that you provide a copy of the recorded deed restriction or regulatory agreement with the public agency which will verify that you have governmental financing or tax credits on the property. And importantly, you'll need to send and submit the certificate of limited partnership of the partnership or any amendment to the certificate of limited partnership. And the reason that's important is in California, you have prima facie evidence of the formation of the limited partnership by showing the certificate of limited partnership. And the reason why there are amendments to this is there are instances, if it's a joint venture and there's a for-profit corporation, there are instances where the for-profit corporation will form the limited partnership and at a later date, admit the nonprofit corporation. So in those instances, the nonprofit general partner is admitted through an amendment of the certificate of limited partnership. In instances where there's only one general partner and it is the nonprofit corporation, a certificate of limited partnership showing the nonprofit as a general partner will suffice, and there's no need to amend it. If the claimant is successful in applying for the various OCCs and the SCC, which I discussed above, the board will issue a finding sheet and either tell you that the exemption has been granted. There'll be a check the box type identified on there that says that the requirements have been met or have not been met. If the requirements have not been met, there's generally a 30-day cure period to submit to the assessor and the BOE, demonstrating that the property meets the requirements of 214G. And once the SCC is granted, it's essentially valid until it's revoked. And just quickly, sometimes we do have various clients that may have a supplemental clearance certificate for the property rejected, and very commonly it's the fact that the limited partnership agreement may be missing one of the requirements from Board Property Tax Rule 140.1. So it's critical to make sure that you get those requirements in your limited partnership agreement. In a nutshell, I think that's how it works. So I think at this point, it seems like there's a couple of questions, Carl, that we may want to try to address here.
Yeah, let me try knocking out a couple, then you can knock out all the rest that I probably should let you handle anyway. One good question I just saw from Marie, and I'll kind of simplify her question. You mentioned a 501c3 that is owned by a public entity, and they have a space in a no-income housing. So I will say, like, nonprofits and public entities can get kind of complicated. Nonprofits are never quite owned, but they can be controlled, and sometimes it saves you from getting an exemption. I do just want to kind of underline, and so it may be that the entity qualifies for the public agency, exemption. On the welfare exemption point, I want to kind of point out one important concept, which is that although you can't prorate by time, you can prorate by space. What do I mean by that? So if you say 90% of the year I use it for an exempt activity and 10% I use it for a restaurant, you get 0 exemption. If you say I use 90% of the property for an exempt activity all year round, and I use 10% of the property for a restaurant all year round, well, you get 90% exemption. So that's what I mean when I say you can prorate in terms of space. So you can you may be able to carve out the restaurant if the restaurant's not related to your exempt activity and you can't fit it in that kind of gift shop snack bar example. You may still have exemption, but you may just have less of it. I think there was one more on the Q&A side. I mean, Jake, you asked a good question of, are for-profit affordable housing developers able to utilize the welfare exemption? If so, how? I mean, I think the answer to that, Daniel, is they accomplish that by being the administrative general partner and or the financier in these projects. Is that right?
Yeah, right. So yeah, the for-profits, and when we say for-profit, we're really talking about a general partner in a limited partnership structure. So in a sense, yes, they are able to benefit, assuming that you meet the requirements of the welfare exemption tax rules, which is you have to have a nonprofit managing general partner. If that is your ownership structure, then yes, you can have an entity that's a joint venture with for-profits and qualify for the tax exemption. But key to that, again, is having a managing general partner, which is a nonprofit.
I'm looking a couple. I grabbed one other question. John asked if we have a number of qualified projects in an area and maintain a separate property, not part of any of the specific projects, but used exclusively to service low-income tenants, can that be exempt? I think this is a good example of where, if I'm understanding the question correctly, why the welfare exemption could be relevant. And the answer is, of course, as always, is it depends. So let's say you have a bunch of housing projects, and those are all either in the structure Daniel mentioned or the simple structure that I talked about, and they're all exempt. And you have some other property and it serves those tenants. Well, I guess I would say the question I would have back to you is, what is it doing? So first, is it owned by a nonprofit? Is that project exclusively operated by a nonprofit? And is the stuff that it is doing exclusively charitable? And so there are ways in which certain kinds of activities can be charitable: counseling services, social work services. If it's just a straight up store, straight up restaurant that has no charitable activity, then it is in competition with other commercial actors, that is not a charitable activity and doesn't qualify. If it's done in a way, if it's a job training program, you can get, there's a lot of different ways to make business activities charitable. It could be. And so this is the kind of thing that Daniel and I talk to nonprofits all the time about what's charitable, what's not. And Daniel does kind of assesses projects like that. And that's the kind of thing to dig into. One question, and I'll just ask this question to you, Daniel: should you apply for the welfare exemption as soon as the construction loan is closing, or when should you submit your welfare exemption? There's actually a few questions about timing. Would it be useful just to, when do you usually do this? Would be a good question for you, I think.
Yeah, I think I mean, I think I should just, as a disclaimer, every project is very fact specific and intensive, and every analysis is done on a case by case basis. But generally, I do think people do apply during construction. There are exemptions in the welfare tax exemption that allow properties to be qualifying during construction. There are also provisions in these requirements that allow owners to receive a refund or a cancellation of property taxes should they have been charged during that period. But again, it's very fact specific and on case by case basis. But generally, I think the answer is yes.
And is it generally true? This is kind of a related question. And there's people asked about the OCC versus when to apply for the welfare exemption. What I've always been told and thought is, theoretically, you can apply for the OCC and the welfare exemption in most counties, everywhere, but in most counties or many counties, they might not process your exemption application claim until the OCC is in. Is that your experience? And is that true for the SCC or the supplemental OCC?
Yeah, I mean, generally, yeah. I mean, I think for the most part, when you have a nonprofit partner, it's very common to have the 501c3 already qualified and have an OCC. So assuming you form an LLC, it takes a little bit of time. So in that fact scenario, typically the nonprofit, after it's acquired the property with the other partners, will go in for an OCC and file for its supplemental clearance certificate as well. And it depends on the county assessor. Sometimes those are done in conjunction with each other. Sometimes they're staggered.
Yeah, and I know one question was, is there anything, to kind of break that backlog? And I certainly have no silver bullets. I mean, Daniel, or any, I suspect the answer is the same, especially every county kind of being different and how it processes stuff. I'm not sure there's a great answer, but I'm sure we're happy to chat after the call. Unless you have anything else, Daniel, on that one.
Yeah, I just want to quickly, I think we have a minute here. There's a lot of questions about what's the actual income restriction that qualifies.
Yeah, that'd be great.
Carl, you agree. I think the answer is 80% is under 80% AMI. But in typically in these types of affordable housing projects, you're restricted to much lower income and rent restrictions. We're typically looking at 30, 50% and 60% AMI.
Yeah. And I think there are tons and tons of great questions, and do feel free to email either Daniel or myself And if it's a question I can't answer, I will just gladly forward to Daniel. But certainly happy to talk about anything from a nonprofit perspective and some of these questions we talked about here. And I'm sure Daniel is the same. And these slides are very much available after. And if I can think of any resources to pass along to SCAMP, I will. I think both Daniel and I are thinking about trying to work on good guides for this kind of thing. So it could be useful. So I hope this was helpful. Oh, go ahead, Daniel, please.
Yeah, quickly, I'll just say, it's a very simple concept on paper to look at this and understand how it works, but mechanically, I think it's nuanced enough that there are a lot of questions out there and stuff is very specific and fact intensive. So, I would encourage folks, to the extent that you have questions, to reach out either to myself or Carl, and hopefully we can help you.
Great. And so thank you everyone for joining. Really appreciate SCAMP for letting us do this, and I'm sure we'll see everyone around.